In a widely expected move, the Federal Reserve announced that it is leaving interest rates unchanged. The central bank did signal plans to raise rates once more before the end of the year. So with only 2 Fed meetings left in 2023, when should investors expect the hike? And what does it mean for you? Yahoo Finance spoke to top names on Wall Street about what's next.
Well, we're counting down to this afternoon's Fed decision, but with expectations of a pause, much of investor focus is on what Chair Jay Powell will say about the November meeting and the market risks that come with it. For more on what to expect from Powell and the Fed today, let's welcome John McClain, Brandywine Global Portfolio Manager. Good to have you on the show here, one of the coolest names in finance. I'm quite jealous. So I want to ask you, though, because a lot of investors, they're really pricing in a pause for this meeting. Is there any chance, though, that the Fed could surprise at the moment?
I don't think the Fed is going to surprise in terms of hiking this meeting. I think where the surprise may be felt is in the dot plots and the revision upward as we expect to those dots, meaning higher for longer. I think, really the market is far too sanguine about a further hike. We think probably happens in November or December. The expectation is about 30% right now. And then really the number of cuts being priced into the market at this time, about 3 in 2024. I think that's going to come down after Powell speaks.
And so, John, with that in mind, being that they've really priced in a pause at the moment, then what do you see as the biggest risks for the market right now, especially since we are a long way away from November in terms of a lot of the data that's still going to come out between now and then?
Well, the biggest risk for the market at this point is really inflation coming back, because good news is bad news for the market in terms of inflation. So, the stronger the economy is, the longer the economy kind of, keeps trucking along here, the more ammo that gives the Fed to hike further. And look, I think eventually we're going to have a recession. We've had an inverted yield curve for an extended period of time. And the viciousness really of this hiking cycle will eventually create a slowdown. But we need to see asset prices come down meaningfully to get the consumer to stop spending. So really, at this point, the biggest risk is inflation creeping back up in the back half of the year.
And obviously, you have the Magnificent Seven, which has really been driving a lot of the gains that we've seen so far this year. Do you think a lot of that focus, and as we sort of seen that progress sort of spread throughout the broader markets, how much of that is going to perhaps change at some point? Are we going to be due for a correction?
Well, look, you haven't had a strong breadth in the market. You have had 7 companies, and a lot of that's driven on AI. A lot of that's driven on China relations. So if either one of those things starts to cool a bit, you will see a meaningful pullback. And I think really what we're saying is when you look at equities, they're priced for perfection at this point in time. You're trading at a 20 times PE. With T-bills well north of 5%. So you've got the earnings yield on the S&P 500 well below where T-bills are. And that's typically not what we see in this market.
And what do you think that markets should be pricing in at the moment? When you look at some of these recession risks ahead, depending on what the Fed does, if they do decide to hike again in November versus, say, just stay the course and stay data dependent and let the medicine take its course?
Yeah, it's a tale of 2 different marketplaces. When we look at investment grade and high yield corporates with spreads reasonably tight, that still actually makes sense to us because we think companies have dynamically changed over the past decade and really don't face, particularly in the higher credit part of the marketplace, don't face meaningful default risk. While interest costs are going up, that's fine for these companies. It just really creates a lack of free cash flow that goes to equity holders through dividends or share buybacks. Now, the equity market's is certainly a little bit different here. I mean, I think it's like we said, it's pricing in a soft landing, and it's really ignoring the fact that the cost of capital has gone up by 400 or 500 basis points for companies over the past 18 months. And that management teams' capital allocation policies are really focusing more on debt repayment and living within interest coverage ratios as opposed to shareholder-friendly activity. So we see the equity markets as being particularly overvalued in the U.S.
And John, in terms of the questions that your clients have for you regarding sort of the Fed's next moves and really how to manage their portfolios and allocate in this sort of environment, how are you advising them? What's really standing out to you?
Well, I think the obvious place to be is in credit at this point, given we're kind of in the seventh inning stretch of, I think, heading towards a recession over time. Higher interest expense, as I said before, pays lenders to the expense of equity holders for the foreseeable future. So we're saying to clients, hey, look, if you're thinking about a traditional 60-40 portfolio, that probably needs to flip more to credit exposure at this point, because we're back to getting paid yields across fixed income that are at 15-year highs. This is a very attractive time for clients to be repositioning away from equities, which you think are reasonably frothy, into fixed income marketplaces.
And John, of course, looking internationally, especially as we think about the pressure that we've seen with the dollar as well, anything overseas in the international markets, obviously China's still a bit of an unknown in terms of its recovery picture at the moment, though seeing some sort of green shoots, especially when it comes to the consumer.
Yeah, I mean, I think, what we're paying attention to in China is policy response, and you're certainly starting to see it. But I think that it's not enough at this point, and we're going to have to see more policy adjustments from the PBOC. And so we see downside risk to China, generically speaking. And then in terms of Europe, still a bit of a mixed bag there.
And just quickly, I want to ask you, because we have seen quite a bit of divergence between central banks in their efforts to tackle inflation. Usually when we see, especially the Reserve Bank of Australia, that tends to sort of plot where we might see the US Fed go. But when you have a divergence like this, what are some of the signals that you find most helpful when you're trying to figure out what perhaps our Fed might do next?
Well, it's tricky, right? There's too much noise in the market, and you really got to focus on what matters. And what matters is the Fed's dual mandate, which is unemployment and price stability. And so when you have CPI trending lower, yes, but still meaningfully above where their long-term target is, and then you've got unemployment, yes, it's a lagging indicator, but still near the lows here. Really, I think that the mindset for the Fed is pretty simple, because you kind of faced with two doors. Door number one is threading the needle, which is extremely difficult to do. I think pausing to engineer a soft landing could be disastrous if inflation reemerges into a slowing economy. Or door number two, which I think is more logical, which is you're going to create an economic slowdown with tight monetary policy, which can then easily be corrected with loose monetary policy. So to us, we're pulling it down to the Fed's dual mandate, and we're ignoring a lot of the noise in the market.
And the Fed certainly has been holding steady to that dual mandate and ignoring all the calls to, perhaps have a 3% inflation target. As Jay Powell already said, that's not happening. Great having you on with your insights. John McClain there, Brandywine Global Portfolio Manager. Thank you so much.
Well, expecting a hawkish hold, the Fed is widely expected to hold rates steady at today's meeting. There seems to be a consensus among Wall Street that the pause in rate hikes this month might be the right move. But the big question here is, are we still on course for one more quarter-point hike this year? For more on the Fed's policy decision, we are joined by Kathy Jones, Charles Schwab's chief fixed income strategist. We also have Gina Smilek, New York Times Federal Reserve and economy reporter. Great to see both of you. Gina, let me start with you, because you've got a great pulse of what is going on in the Fed, what exactly those conversations are like amongst Fed officials right now. Given the recent spike that we've seen in energy prices, what do you think the tone, what do you think the narrative is going to be this afternoon?
I think with the Fed in general recently, it's really been about keeping your options open, remaining flexible, remaining, wary and conscious that the storyline can change. The Fed was really burned pretty badly in 2021 when they expected inflation to fade and then discovered it didn't. So I think that while they've been really encouraged by the slowdown in inflation this summer, which really has sort of confirmed a lot of what they had expected might happen and has actually even been a little bit quicker than a lot of Fed officials were predicting, I think that they're going to be hesitant to take a victory lap just because they don't want to be caught out again. They don't want to say, we've won the inflation battle, this is over, we've done the deed, and then only to discover that inflation reaccelerates because of oil prices or because of some other factor.
And Kathy, I want to bring you into this as well. I mean, at the last meeting, 9 members were looking for one more rate hike. 3 were looking for more than that, according to the dot plot data. Where do you believe the consensus will be following today's conclusion of their 2-day meeting?
I think it will stay. The overwhelming consensus will still stay with one more rate hike, because I don't think that there's, as Gina mentioned, just a lot of confidence that they can declare victory yet, and they know that we're done with the rate hikes because of the uncertainty around inflation going forward. But there may be a little bit of a migration down. So some of those dots that were above that line might move a little bit lower. Maybe a couple at the median will move down a little bit. It seems to be a growing kind of consensus among at least a small number of Fed officials that perhaps enough has been done for now and that they should continue to be patient. But overall, as Gina mentioned, I think they want to keep their options open. I don't think they want to signal that they have too much confidence that they've declared victory at this stage of the game.
Gina, what do you think Fed officials need to see in order to feel a bit more comfortable moving on to that next phase of policy?
I think what they probably want to see is a continuation of some of the trends that we saw really start to take hold this summer. So I think they've been waiting for a concerted slowdown in the labor market, and you're finally starting to get that. So I think that's going to make them believe that supply and demand for workers is coming back into balance, and that we might see sort of sustainable growth going forward there. I think they probably want to see a slowdown in consumer spending. I'm not sure that that's really materialized to the degree that they had expected so far. We're still getting pretty good retail sales reports. If you read earnings calls, people are nervous, but Walmart's expecting a really good holiday season, and so I think that's been kind of a mixed bag. And then finally, I think they really truly are just looking at these inflation figures. We've seen a real slowdown both in goods, which they were always expecting those to slow down, but also in some important services categories in recent months. And I think if that's sustained, that's going to make Fed officials a lot more confident that they've sort of done what they needed to do to make sure that inflation comes sort of sustainably back under control.
Ginny, just to stay with you for a hot second, is there a magic word that we could potentially hear from the Fed that would quell some of the market's concerns, perhaps around any uncertainty that could proceed at the end of today's meeting?
Yeah, I think that, I don't know if there's one single magic word, but I think that anything that you hear about risks being balanced might be a magic word there. For a long time, Fed officials have been very clear that the risk of inflation was the risk they were more concerned about. They were more worried that inflation was going to stay out of control than they were that they were going to do too much and hurt the economy. The more that they're trying to balance those two risks, not trying to overdo it and hurt the economy too much on one hand, and making sure that they slow things enough to get inflation under control on the other, the more those are being balanced, the less likely it is that the Fed is going to be willing to tolerate or precipitate a recession. And so I think from the market's perspective, that would be a very good news.
Kathy, what do you think about the moves that we've seen in the 10-year yield? Here we are, I guess we're pulling back this morning just a little bit from the highest levels that we've seen since 2007. Have we peaked? Are we near peak levels for the 10-year yield?
Yeah, we think we're near peak levels. You can't rule out a further move up in yields from here, depending on how growth performs. But what's interesting about this move in yields is it's all been real yields after adjusting for inflation expectations. So it's really been an adjustment to a stronger path of economic growth. And I think the supply coming in as we grow deficits, the idea that there'll be more and more financing that needs to be done by the Treasury, and that's boosted yields a bit. But I think as we turn the corner and get more confidence in the decline in inflation, which we're expecting to happen over the next couple of months, then those yields will roll over. So typically, we have an inverted yield curve. Typically, at the end of the rate hike cycle, you have this inverted yield curve with short-term rates higher than long-term rates. As you go into the other side of the cycle, you see it reverse with short-term rates falling relative to long-term rates and the whole curve coming down. So that's our expectation sometime in 2024.
And when you think about what's going to really be taking up a lot of the air today, Kathy, I mean, anything from housing, oil, still the international part of what's playing out, especially driving oil and the correlation there. What do you think the top discussion point that the Fed is going to have to really wade through over these past 2 days has been or has to be?
I think it's more the labor market. So if oil prices, the Fed typically looks through food and energy because they're so volatile. And frankly, there's not much they can do if OPEC cuts supply and pushes the price up. They can't keep adjusting monetary policy every time crude rallies $5 or $10, right? That would be a highly volatile policy setting. Obviously, if that flows through, those crude prices flow through to finished goods in a sustainable way, that's a concern for the Fed. But I do think that they'll focus more on the labor market, and that's one of the issues that they've been watching really closely. We've seen growth in job growth slow down a bit. We've seen wage growth slow down a bit. I think the question for the Fed will be, has enough been done to loosen up that labor market so that we're not getting that push for inflation coming from the growth in income above inflation? I think we're probably turning that corner, but again, I'm not sure the Fed is going to be overly confident of it, and that's what they're going to be focused on.
Yeah, if they were to add on the OPEC policy hat onto their plate, then they certainly would be moving from dual mandate up to a Trinity-type mandate. We don't want that. Kathy Jones, Charles Schwab's chief fixed income strategist, as well as Gina Smilik, who is the New York Times Federal Reserve and economy reporter. We've got a lot to watch here later today as well. We know you will be too. Thanks so much for joining us here ahead of the Fed decision.
No change. The Federal Reserve holding rates steady in the range of 5.25% to 5.5%, but leaving the door open for one more rate hike. Officials still see rates peaking in the range of 5.5% to 5.75%, implying one more rate hike from here. Now, 12 members are for one more rate hike, but 7 members actually wanted to keep rates at current levels. Now, when it comes to next year and rate cuts, officials now pricing in at the median 50 basis points of rate cuts from the expected peak of 5.5% to 5.75%. That's 50 basis points less than what was expected back in June, implying that officials see holding rates at higher levels for longer. Now, when it comes to future rate hikes, they said that will have to be contingent on the impact of previous rate hikes on the economy as well as economic developments. Now, the Fed retaining language in their statement buttressing this so-called dot plot that, quote, in determining the extent to which additional policy firming may be appropriate, the committee will take into account cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Now, Fed officials noted in their statement that they still view inflation as, quote, elevated, and they remain highly attentive to inflation risks. Though they lowered their outlook for inflation, they now see inflation at 3.7% this year. That's down from 3.9% previously forecast. They see it dropping to 2.6% next year. The outlook for GDP was also revised higher to 2.1% from 1% previously, and next year's outlook was also revised higher to 1.5% from 1.1% previously. Now, officials also acknowledged in their statement that job growth has slowed, though they still characterize the job market as robust. They see unemployment now ending the year at 3.8% versus 4.1% previously. This decision was unanimous. Back to you.
And Jennifer, great stuff there. What do you expect to hear from Powell at the presser now?
Hey, Josh, great to see you. Great to have you on board. I really expect Fed Chair Powell to maintain a hawkish stance here. He does not want to send any signal that would loosen financial conditions, because that would mean that the Fed would have to go back in and actually do more work. They have things in the markets right where they want them right now. But at the same time, he wants to maintain that optionality, and that's why they are proposing one more rate hike. If they don't need to use it in November, then they don't need to use it, but they don't want to box themselves into a corner. They really want to avoid a 1970s scenario where inflation seemed like it was coming down under control, but then the Fed ended up having to go back in and really jack rates up higher, plunging the economy into a severe recession that we saw in the early 1980s. And that's really a scenario that Fed Chair Powell wants to avoid.
bring in our next guest, Sonia Meskin, BNY Mellon Investment Management Head of U.S. Macro, as well as Michael Kushma, Morgan Stanley Investment Management CIO of Broad Markets Fixed Income. Michael, I'm going to start with you. I mean, what stood out to you specifically on what we got from the FOMC statement? What are you going to be looking for in this press conference?
Well, I think what it reiterates is this idea of a very soft landing kind of economy, with the unemployment rate forecast being brought down, growth being upgraded significantly for this year and next year. All looks quite good. Why would you want to change interest rates if everything's going in the right direction of lower inflation, lower unemployment, and longer term? Rates are still targeted to drop as much as expected over the long term. That 2.5% terminal rate remains unchanged, so that we won't get as many rate cuts next year. We'll get maybe more than expected in 25, 26. So that's all a pretty benign, longer term view of things without too much stress. So if this forecast is accurate, you can see that without a meaningful recession, that risk assets, high yield bonds, emerging markets should do okay or well.
So, Sonia, Michael's saying maybe this forecast suggests a soft landing, so why mess with rates? Is that your take?
Well, I think the Fed, is never really, until we are clearly seeing a recession, is not in the business of saying we are going to go into a recession. Of course, they're going to, their central scenario is going to be to forecast a soft landing. It's their job to try their best to engineer that. I do think that this is a bit more of a hawkish message than maybe investors were hoping for. We do see this in the price action as well. Only 50 basis points of cuts next year. Certainly markets throughout this year were hoping for more cuts in 2024. They also solidified the view of another hike in 2023. And if you look at the dispersion around their forecast of the neutral rate, they're really moving towards forecasting a higher neutral rate down the road than they do currently. So I do think this is a bit of a hawkish message, and it reinforces the concern in the committee that they may have to do more to get inflation back down to 2%, as patient as they would like to be into 2026. There's still risks that unemployment is not just going to nicely stay around 4% and inflation come down on its own.
Michael, we saw a 10-year T-note yesterday tracking to the highest level we haven't seen since 2007. When you look at where the economic projections are coming from the Fed, what the expectation is potentially another rate hike come end of year, where do you see those yields tracking?
Well, it's an interesting question. I think the longer term, with inflation continuing to trend lower, 10-year bond yields 4% or up, if inflation does return to that low 2% level over time, 10-year bonds look pretty attractive. However, there's a high opportunity cost, with 2-year notes still tracking higher on this idea of Fed funds staying higher for longer. It's very difficult for 10-year bond yields to rally if 2-year yields stay over 5%, and if they're staying over 5% for a longer period of time. I think that's really the message, that from their perspective, the economy is still quite robust despite signs of weakness in potential consumer spending and household spending in the future. So overall, it looks hard for 10-year bond yields to fall meaningfully as long as the economy is as strong as it is and the Fed believes it needs to keep rates this high, unless, of course, we end up with a much stronger slowdown and the Fed's forecast is incorrect about growth. The curve could get more inverted if the Fed has made a tactical error that rates don't need to be this high for this long. Then 10-year yields can rally. But the extent of the inversion of the yield curve suggests that it's very difficult for long-term yields to rally unless 2-year yields come down.
And just following up with that, so Michael pointing out the economy looking sturdy, but looking at it, what do you see the risk to that? Is it the labor market? Is oil? What are you watching? So that one's for Sonia.
Yeah, that's what I thought.
I think, what I would be concerned that labor market does tend to be either a lagging indicator or a coincident indicator. it's not really a forward-looking indicator of the economy. So what I would pay more attention to is what's going on in the credit markets and where exactly are those high rates starting to bite, where are we going to see refinancing walls come up in 2024 and potentially even 2025, since markets tend to be forward-looking. I think that the higher the business expense becomes for most companies and the more difficulty they have financing their operations in a high rate environment, and the more banks become constrained in lending, given the inverted yield curve, the more we can see kind of a slowdown really take hold. But the early signs of that, I think, would be more in the credit markets.
Sonia, what does that mean from an investment standpoint? I mean, this environment of higher for longer, do you sort of move away from the big cap names, maybe go for some of the smaller value plays, small caps? What are you thinking?
I do think individual stock picking and individual credit analysis would do quite well in this environment, because some corporates and some sectors would be better able to withstand these pressures than others. So there's an ample opportunity for stock picking in this environment, I would say, and along the credit lines as well. I would think too that, on the labor market front, you got to keep in mind that likely costs will remain elevated on the structural shortfall of labor supply versus demand in the U.S. And in addition to that, of course, higher energy prices.
And Michael, so Sonia's saying this is a stock pickers market along the credit lines as well. Does that make sense to you for people who are listening in, traders and investors?
I think it does. Interest rates are up substantially from where we were a couple of years ago, and there will be companies in the future which are going to run into difficulty in managing their businesses, especially if they're highly levered or dealing with much higher interest rates on their debt. So focusing on companies which have a strong business model which can withstand the higher interest rates or adjust their business strategy to cope with higher interest rates, whether that requires injection of equity, paying down debt, deleveraging. I think focusing on those issues will be very important, because we had 10 years almost of zero Fed funds rates or close to zero. And that changed corporate behavior and allowed some companies probably to survive and maybe do okay with zero interest rates. But as interest rates look like they're going to stay up in this 4 to 5.5% level for another year or two, that just changes the business outlook for, I think, many companies. So being careful about where you pick industries and companies will be very important.
Michael, really quickly, what does this mean from a fixed income standpoint in terms of investments? You were talking about T-notes. Where else do you look at in debt?
Well, I think that a focus on shorter maturities. You're getting paid a lot of extra yield to hold shorter maturity bonds. Cash out to 3-4 years, where you can buy 2-year corporate bonds, 3-year corporate bonds, over 6% yields. Those look pretty attractive medium term, while you can wait to see how the economy unfolds, how Fed policy unfolds, and then tactically move no longer. It seems unlikely that the Fed's going to have to raise rates meaningfully higher, maybe one more rate hike, but it looks like the outlook looks pretty good for rates peaking these Fed funds rate this year. And that means that we can take advantage of high short-term yields while waiting for an opportunity to extend either credit risk and or maturity risk at some point in the fourth quarter.
Sonia Meskin, BNY Mellon Investment Management, head of U.S. Macro, as well as Morgan Stanley Investment Management, CIO of Broad Markets Fixed Income. Michael Kushma, good to talk to both of you. Really appreciate the time. Let's bring in our panel for much more on the Fed decision today. We've got former Fed Special Advisor Andrew Levin. Also with us, we've got Abigail Watt, Aberdeen Research economist. Great to have both of you today. Abigail, let me just start with you and get your take on what we heard from the Fed so far.
Yeah, I think it's really interesting. I think we were expecting the kind of final hike to remain in the dots for this year. I perhaps think where we've maybe underestimated the changes was in that kind of, 50 basis point move up in the dot for 2025. I think that really kind of signals to 2024. I think that really signals to the markets this kind of higher for longer narrative. And I think this is the kind of line that the Fed is trying to walk between this kind of perhaps undue loosening in financial conditions too soon. And I think that's something that Powell's really going to have to try and walk the balance on in the presser later today.
Andrew, interested to get your take as well, just what you made of the Fed news here, what they did, what they said, and what do you see going forward?
Yeah, well, I agree with Abigail, actually. I think that the shift upward in the medium term dot plot is actually really important. And I think the extent to which their statement today uses the word solid to describe economic activity is a good word. The fears that the people had 6 months ago that we were heading into recession, I think have really faded. So one thing the Fed is reluctant to do is to talk about risks. And I think that the truth is there's an upside risk to the inflation outlook. Their outlook and the projections today is still very rosy. They expect that by the end of next year, inflation is going to be down around 2.5, close to their target. But we can think of lots of scenarios where inflation's still running at 4 or 5%. And then a question, I guess I'm eager to hear from Abigail what she thinks about this. Is the Fed going to need to do more in that scenario where over the next 6 to 9 months, inflation's not sort of stabilizing near their target the way that they were hoping?
Andrew, let's talk specifically about those risks you highlighted. How much of a risk does oil pose right now? We know the Fed likes to look specifically at core inflation, strips out energy, and yet when you look at the recent inflation print, we're talking about gas prices jumping more than 10% in August alone.
Right. Well, I think there's a bunch of reasons why many measures of inflation are actually going to be higher over the next coming months. Another one, in addition to the oil, is that workers are continuing to look for cost of living increases. We're seeing that nominal wage growth still running 2 to 3% higher than it was before the pandemic. In service industries, that's a big part of their cost. They have to pass it on into their prices. And that's part of what you're seeing with UAW, with the auto workers strike. Another factor is healthcare. The way the inflation measures are constructed, healthcare prices have looked really low, and inflation has looked really low over the past year. But that's going to be revised soon, and so we should be prepared that the healthcare component of inflation is going to be rising a lot and putting upward pressure on these inflation measures.
And Andrew brings up an interesting point there with the UAW. I'm interested in how you sort of think about that dynamic as well. You look at this organizing activity, unions on the move. Of course, it's not just the UAW, it's airline pilots, UPS workers, Hollywood actors and writers. And sometimes these unions are going to the table, Abigail, as you know, and they're securing better pay packages themselves. They're boosting wages. How do you think about that dynamic for the economy moving forward?
I think it's a really interesting dynamic, and what you're really seeing is those areas where I guess bargaining power has been increased by labor shortages post-pandemic are those where you're seeing some of those kind of wage hikes coming through and those wage negotiations and strikes taking place. I think from our perspective, the key thing that we're thinking about is the ability to which this actually could lead to stickier wages. We have seen more progress on wages in recent months, and that's coming from the loosening that we've seen in the labour market thus far. But I think from the kind of Fed's perspective and the outlook for inflation in the US, I think that's the main concern that we're thinking about around some of this kind of increased labour bargaining within the US economy. I would say, though, that we have seen kind of an increase in kind of workers in those sectors where you did see the kind of biggest demand supply imbalances in the US labour market. And so the ability for some of these kind of negotiations to continue, I would likely say is kind of becoming less clear, especially as you've seen those adjustments in the labour market.
Abigail, even as we see these labor negotiations continue, we did see Walmart, the biggest employer, come out with that headline last week talking about bringing down some of the hourly wages for workers. That was sort of seen as potentially a harbinger of things to come, that maybe if the largest employer was looking at wages coming down, is that a sign that things are starting to get a little looser in the labor market? How should we view that dynamic?
Yeah, I mean, I think we've certainly seen kind of job openings coming off the boil. You've seen a big decrease in vacancies in the US economy. You've seen job growth itself kind of beginning to decelerate. And I do think that's something that, we were kind of looking for and hoping for in the case of bringing inflation back down to target for the US economy. I think the other thing that I would note is the extent to which that can kind of be be sustained and continue from here.
And Andrew, so let me ask you this. So the Fed holds rates steady, but they indicate maybe one more hike. What would, Andrew, one more hike actually do? I mean, let's say they hike one more time. Would that have a meaningful impact?
No, it's really symbolic. I think that in the scenario I'm worried about, where inflation's turning upward instead of down, by allowing themselves, to still make another rate hike in December, which is probably when it would come if it does, is sort of a way to show that they're not asleep at the wheel. The fundamental problem is that what they're counting on is that actual inflation continues to head downward, and that makes monetary policy tighter as that happens, because if they hold rates at above 5 and inflation's running down at 2.5 or 3, that becomes a fairly tight monetary policy. Think about the interest rates relative to the inflation rate. The problem for them is if inflation continues to run in the range of 4 to 5%, then a rate of 5.5 or 5 3/4 is just not very tight, not going to create much downward pressure on inflation. That's the scenario where they may have to move significantly further.
Abigail, do you agree with that another 25 basis point hike, let's say in November, would be more symbolic, that the fundamentals right now of the economy don't necessarily dictate another rate hike?
I think my concern, actually, I think where I differ is not around inflation stickiness and more around the strength and the resilience in the US economy. I do think, obviously, there's been a clear increase in the probability of a soft landing. But one of the things that we're kind of cognizant of is the number of headwinds that are growing for the US consumer. If we think about student loan repayments coming back in, if we think about the fact that excess savings have been depleted, and that's one of the things that has really helped support the US economy so far this year. I think that's one of the kind of major risks that I see, actually, is that you see inflation pressures coming back down to target, but that's driven by a recession in the US economy and not by kind of, the kind of more benign soft landing dynamics that I think markets are kind of pricing and hoping for currently.
And Andrew, I want to get you out of here on this. We've talked oil. Andrew, we've talked strikes, but another big headline that could be coming here, we're looking at a looming government shutdown. Is it possible, Andrew, if that happens, it slows the economy, is it possible the Fed is looking at as something that would almost help them in a way, that it would slow down the economy? Are they looking for that? Well,
it depends on what kind of shutdown. If it's over a weekend or a few days, it's a kind of drop in the bucket. If it's long and deep, that could definitely create further frictions. Like Abigail said, there's downside risk to the growth outlook. But Congress knows they're heading into election year, and so the extent to which they would allow a government shutdown to cause a recession, that would be really surprising for members of Congress to do that. So my expectation is that they'll figure out a way. And again, there might be a symbolic shutdown for 2 hours or 12 hours. That's happened before, but hopefully not something that derails what now is currently a pretty solid economy. All right, Andrew Levin and Abigail Watt, thank you so much for that conversation. Very helpful.
While the FOMC declined to raise rates at its most recent meeting, keeping it steady at a 22-year high, the dot plot showing that most Fed officials still think one more hike is necessary before the end of the year. On this, we want to bring in Esther George, former Federal Reserve Bank of Kansas City CEO and president. Ms. George, it's great to have you here. Thanks so much for taking the time to join us. So I think investors are still digesting what we heard from Chair Powell yesterday. But when it comes to those projections, right, that was the main focal point. The fact that officials still think that one more hike might be necessary before the end of the year, and we could be in this higher for longer environment through 2024. What's your reaction to that?
Yeah, well, good morning, and thank you for having me. I think as you look at the messaging coming out of the Federal Reserve, and again reiterated yesterday, this is a committee that wants to keep the focus on its restrictive policy, bringing down inflation. They have been very clear that they want to get back to that 2% target. It's proved to be a little bit tougher in terms of a timeline for doing that. And so the messaging yesterday, including the dots, I thought were really trying to keep the focus on higher for longer in order to bring that inflation down.
Does this sound to you like a Fed that believes firmly in that a soft landing is going to be achieved?
Well, you heard the chairman ask that a couple of times yesterday. And clearly, this committee does not want to damage the economy. They would love to see those imbalances between demand and supply work their way out to a soft landing. The truth is, though, that isn't guaranteed. And really, the goal of that committee is to restore price stability. A soft landing would be a scenario where they're able to do that with little impact to the labor market. And you see that in their dots. On the other hand, they have also said there could be some pain involved in trying to restore price stability. And that pain typically comes in the form of a higher unemployment rate. So I think they're looking at a variety of scenarios at this point. They're getting close, they think, but not yet ready to say they've arrived at the destination.
Ms. George, what do you think is most likely at this point, given what we heard from the Fed yesterday? Do you think a soft landing is more likely, or maybe we'll see the other scenario that we've been talking about a hard landing?
So as I look at the outlook for the economy, clearly the consumer has been resilient, but I am also watching the fact that these excess savings, this money that has really shored up the consumer over the last few years, is waning at this point. We also see the uncertainty coming from strikes by auto workers and others. We see the threat of a government shutdown. And we also see globally that some of our trading partners are in a weaker position than we are with their economies. And so all of those things, to me, are a confluence of areas to watch that could hit the economy at some point. And finally, I would say, when you have this kind of a rate hike, 500 basis points plus, at a time when the Fed is also shedding its balance sheet, you are getting restrictive policy. And as that works its way through the economy, that, of course, can create some downdrafts. So I'm looking at a number of things that threaten that soft landing scenario. I think they're legitimate. I hope they don't come about. It would be great if the soft landing were the outcome. But I think the reality suggests that we need to be focused on what some of those risks are.
And when we think about what the Fed was expected to talk about coming into this meeting, oil was expected to be on the docket of conversation. Do you believe that we got any clarity about how the FOMC voting and committee members are looking across where the range of prices are that consumers are incurring and businesses are incurring as well for producing goods, and saying and assessing the broader oil or energy portion of those costs too?
Yeah, I think you're right. And I have to believe this was a central part of their conversation yesterday. We'll see when the minutes come out in a few weeks how they were judging energy markets, for example. But you're right. Anytime energy and food prices are at the levels they are today, they are hitting the consumer directly. And even though the Fed can look through those headline numbers and look at the core, we do know that higher energy costs when you pull up to the gas pump and fill your car is front and center in the minds of consumers. It does impact their ability to pay for things, to make trade-offs, the same with food prices. So those two things are very salient in the mind of households in terms of how they look at forward inflation, in terms of how good they feel about the economy. And I think today we know from looking at various consumer surveys, consumers don't feel very good about the economy. And that most certainly has to do with those prices in particular that they're facing.
Do you think then we'll see a further deterioration in the consumer? Because up until this point, the consumer has remained so resilient. And when you compare what we're seeing today to what we were hearing from forecasters 6 to 12 months ago, we're looking at a totally different scenario.
Yeah, no, that's true. The thing in the favor of the consumer right now is the low unemployment rate. So to the extent that people have jobs, their wages have been going up, that gives people confidence and they will spend. On the other hand, we know that a lot of the demand we saw coming through the pandemic came from these excess savings, money that was transferred from the government's balance sheet to households and small businesses is running down. And the question is, will the consumer hold on to that in a cautionary fashion? Will they continue to spend out of that excess savings? Will they begin to borrow to maintain this level of expenditure while prices are high? Remains to be seen. But I think you have seen some moderation in consumer behavior, and I think we will continue to see that over the coming months.
And just lastly, while we have you here, as we think about the potential for a cut at some point next year, if you're sitting in the committee and you're thinking about what is going to, at the other side of whatever type of landing we do get, spur demand, drive people back into the housing market, how soon would you be anticipating or thinking about a cut?
Well, it's hard to pinpoint the time frame for that, but I think some of the things that this committee might be looking for is what happens in the labor market. The labor market gives a signal of whether demand has fallen in a way that causes businesses to turn loose of people. And of course, right now we don't see that. In fact, just the opposite. People are hanging on to their workers because of how difficult it was to attract and retain them over the last few years. So I think pushing out the expected rate cuts is probably right, given the scenarios we've seen. On the other hand, I think at the end of this year, you could begin to see the impacts of the uncertainty around this government shutdown, around some of the strikes and the shutdowns that have happened in the auto sector. There could be other things as this tighter policy works its way through that will signal the economy is cooling in a way that the committee will not only be comfortable leaving rates, but anticipating those cuts sometime in the first half of next year.
Meanwhile, the lack of homes for sale and the Federal Reserve's determination to bring down inflation by using high interest rates, well, those forces are coming to a head in the housing market. Yahoo Finance's Danny Romero joins us with more on this. Danny, what are you watching?
Hi, Rochelle. Well, the U.S. is dealing with a housing affordability issue. There is recent data that really highlights the issue at hand. Builders are facing a dilemma right now that if they build a home, they most likely will have to help that buyer afford that home, given the fact that mortgage rates are hovering over that 7% or hold back. But if they hold back, then that prolongs the issue of supply and inventory that the housing market needs. And data out on Tuesday really highlights the slowdown in home building. Housing starts fell over 11% in August, driven by the drop in multifamily units, that's condos, apartments, but single family starts also fell too. This aligns with another survey out this week on Monday that really showed a very sour sentiment around home builders. Home builders are losing some of their steam, their confidence and enthusiasm that they had earlier this year. And home prices are rising. We have to add that to the equation as well. So that's further squeezing the affordability problem right now. What does this signal? Higher mortgage rates is not only taking a toll on home builder confidence, but also consumer demand. So what's the solution here? Well, more supply. But if builders are skittish about rates and affordability, then that will further cause an imbalance in the supply, which we definitely need in the U.S. Rochelle?
So then, Danny, with that in mind, KB Home reports earnings after the bell. What are the key takeaways that you're going to be looking for?
KB Home is a home builder that thrives off of build to order strategy. And in this third quarter results, one of the big prime highlights that I'm hoping to hear a lot from is the buyer demand. In the second quarter, KB Home focused on entry level buyers. Is that happening this quarter, or was there a little bit of a shift? Also incentive perks. We've heard across all the home builders about some of the incentives they've been offering, such as mortgage rate buy downs to really boost some of the sales. Is that what happened this quarter? And cancellation rate. This goes hand in hand with buyer demand. Are buyers getting cold feet? We've been hearing a little bit of that in the resale market. There's been some pullback. And then finally, to round out everything, is the outlook. Is the company going to increase their housing starts, or are they going to be going through their backlog? That will really signal how this home builder is really hoping to end the year. Is it with a bang, or is there some softness ahead? Rochelle?
Certainly a very different time when buyers were sort of hand over fist, waving all contingencies at the peak of COVID. And now look at where we are now. So it'll be interesting to take a close look at that outlook. Appreciate you, as always, our very own Danny Romero.